stock market that I just put up on the screen. So it ends up being a little bit of a Rorschach test. What do you want to focus on? By the same token, are financial conditions tight here? It sort of really depends what you look at. In any case, we are going to see how the Fed thinks about all of this in just about 10 seconds. Heading into this, again, our survey says that just about unanimously, everybody's looking for a quarter-point cut going into this. And we should get the data just about now. Yep. So you get your quarter-point cut. Your new range is 3.75% to 4%. I will take you over for some very quick market reaction. Not much doing in the stock market on the S&P 500 off the back of that very initial move. Although no sooner had I said that you get a spike up. That's the magic of the John Levin call. I say something and the opposite thing happens. So we see the stock market moving up a little bit off of the back of this decision. We see the yield on your 2-year Treasury note trading just about 3.52%. Now, let me take you over to some headlines here from our live blog. Let's see here. Okay, so digging into the details, we have the Fed. Wait, let me get this for you right. Fed says, okay, they're coming fast, folks. Hold on, hold tight. So the Fed cuts the target range for the benchmark by 25 basis points to 375 to 4. The Fed says it will stop shrinking the balance sheet on December 1st. Fed says Myron dissented in favor of a half-point cut. Fed says Schmidt dissented in favor of no rate change. So there you go. We are getting the end of QT, as was somewhat expected. We are seeing less agreement on the Federal Reserve here as the choices get a little bit harder. What do you make of that, Greg? What do you make of the fact that it feels like an error of consensus on the Federal Reserve seems to be coming to a close as the easy decisions are now behind us? How should we think about that?
Yeah, well, Powell has commented on that a number of times, right? He's said that consensus is great, but getting it right is better and more important. I think what you're seeing here in the statement, I'm just reading through the changes of the statement. They're talking about available data that has shown the economy expanding at a moderate pace, that the unemployment rate remains low through August, but that more recent indicators are consistent with developments showing slower job gains, and that downside risk to employment rose in recent months instead of have risen. That essentially points to a picture where essentially there's going to be this bifurcation in terms of the FOMC. We know as of September, there were 9 policymakers that favored essentially cutting twice more or less over the course of the October and December meeting, and 10 policymakers that favored cutting 3 times over the course of 2025 or more. And what you're seeing there is this bifurcation. You have some amongst the Fed leadership, including Governor Myron, favoring a larger easing of monetary policy, a more rapid return to a neutral stance. And then you have regional Fed presidents that are generally in favor of slightly tighter and a more gradual easing of monetary policy. Today with Schmidt preferring essentially no change to the federal funds rate in the absence of data. So that tension, I think, is very much going to be present, not just over the next couple of months, but really into 2026, when we have a more hawkish rotation of regional Fed presidents and likely a more dovish leadership at the Fed amongst governors.
Allison, what do you make of all that? I gather from our past conversations that you're sort of critical of this sometimes phony seeming consensus over on the FOMC. How do you feel about the fact that some people are starting to disagree about the direction of policy here?
Well, I think it's super healthy because honestly, I think you could make a case that cutting again is totally bananas. I mean, look at the stock market, look at credit spreads. It's hard to argue that we are in a contractionary environment. And oh, yeah, like inflation is still 100 basis points above target. And yet they're still saying that we're going to go down to 2% within 3 years. And that just seems to be pushed out and pushed out and pushed out. So, I mean, again, like as Greg points out, there are some bad vibes here. There is a weakening labor market. There is an argument to cut. But the idea that this, that there would be consensus around that just to me suggests a lot of bad groupthink and a Fed that I don't know if it's just been captured or it's just way too oriented towards one half of the mandate.
Yeah. All right. Well, Allison, let me stay with you because the other big news here coming out, of course, is the balance sheet decision. Okay. So the Fed, the Fed has been through a couple of years of letting securities roll off its massive balance sheet, which now stands at about $6.6 trillion. Glad to see we have the graphic up on the screen here. So the idea of quantitative tightening here, in a sense, it wasn't really an active policy. It was the undoing of quantitative easing, right? So, we could look at it and we could say the portfolio as a percentage of nominal GDP is roughly back to where it was in 2019. So isn't this the right time to sort of turn off the spigot and go back into neutral, so to speak, when it comes to the balance sheet?
Well, I wouldn't say 2019. It jumped up in 2020. They're pretty much where they were when they started buying assets like crazy during the pandemic. And I mean, I think this just is a real shift in monetary policy. Quantitative easing was supposed to be this extraordinary thing we did during the financial crisis. And then you could argue during the pandemic when, bond markets were completely frozen to get them going again. And now it's just like, no, the Fed buys a lot of, I'm assuming when they say they're going to end quantitative tightening, they're going to buy more long-term treasuries? Is this what their plan is? Do we know?
Well, obviously, I think they have some choices to make about where they're going to reinvest the proceeds going forward. But yeah, I mean, the idea is, you're now more or less going to keep the portfolio at the current size. So that means things mature and you need to go out and buy other things, right?
So they're participating in sort of this part of the bond market, which honestly, it's a dangerous game they're playing here in terms of Fed independence, because it really does open up the door to more yield curve control and financial repression and all of these things that can make the Fed a lot more political. I think what we're seeing in terms of this danger of the Fed being politicized with President Trump is very worrying, but I'm not sure why the Fed is giving him another lever to push on them, particularly as debt costs become a bigger issue. We're going to see a lot more pressure for the Fed to do yield curve control. And as long as they're, like, hey, we're buying a lot of long-term assets to maintain the size of our balance sheet, this just becomes a very dangerous game for them.
All right. Well, let me throw out one. Sorry, Greg, you go ahead.
Yeah, just in terms of the reinvestment, beginning December 1st, the Fed will reinvest all principal payments of their holdings of agency securities into Treasury bills. So there is a shift towards shorter dated Treasuries.
All right.
That's good.
And what do you think of this notion? We'll have to get into the details of how the latest statement dovetails with this. But what do you think of this notion that was thrown out there by Governor Bowman, Vice Chair for Supervision, that perhaps the way the Fed should approach this is through a sort of neutral distribution to the Treasury market? In other words, their footprint should more or less mirror the bond market itself, right? They should not be, so to speak, overweight the long end or overweight the belly. They should seek to have a neutral portfolio that, in a sense, mirrors the market itself, and in that way avoids creating these distortions. Would a strategy like that satisfy you guys? What do you think?
I mean, generally speaking, I think that's a better approach in normal times, right? Whenever there is no need or desire to implement any type of policy shift using the balance sheet, you really want to be as neutral as possible. So I think the decision to reinvest in shorter dated treasuries is in fact a reflection of that, wanting to move away from this overweight on long duration and buy treasury bills instead of longer term treasury securities. So I think that's a step in the right direction of neutralizing the composition of the Fed's balance sheet, and getting back on this steady trajectory where essentially you have the same type of growth in the balance sheet in line with currency in circulation. So more of a neutralization of that tool, and back to a focus really on the Fed funds rate as being the primary tool to conduct monetary policy. And that's again where there's going to be a lot of polarization amongst the different policymakers.
Yeah, and with this move towards the short end, am I right to assume that this sort of comes hand in hand with more flexibility? Don't you think? Right, you're buying short dated bills; they're constantly rolling over. It just leaves you more flexible over the medium haul, don't you think? Greg?
Yeah, it does. I mean, it does two things. I mean, when you have the ability to play with the duration, you can do things like the twist operation if there is a need or a desire to put upward or downward pressure on short or long-term rates. So I think that is very much part of the picture. One thing that's going to be very interesting as we move into next year is essentially this growing gap between short-term rates and long-term rates, the yield curve steepening potentially as a result of essentially a fiscal situation that is concerning, with the debt to GDP ratio continuing to rise and interest expenses continuing to rise, with inflation risks on the rise as a result of tariffs and this gradual and uneven pass-through of tariffs onto inflation. And then with questions, as Allison was mentioning, as to Fed independence, right? There's ongoing pressure still on the Fed, whether via the governors or via next year, the chair position, that can lead to this widening spread between short and long-term interest rates, and in turn, potentially hinder the pass-through of monetary policy onto the economy. And this comes at a critical juncture because, to come back to one of the things that Allison was mentioning, knowing how restrictive monetary policy is and knowing how tight financial conditions are requires understanding essentially how the different components of the economy, how the different sectors of the economy are doing. And one of the interesting characteristics today is that we don't have a uniform consumer. We don't have a uniform business environment. I would argue we don't even have a uniform financial market environment. You have affluent consumers still spending and not really constrained by monetary policy at this stage. Lower end consumer are a little bit more judicious in their outlays because they're facing these higher price pressures, because they're constrained on the credit front, because their balance sheets are less healthy. And the same picture can be told of the business sector. Anything that touches AI, whether it's the chips, the infrastructure, the data centers, the energy, the software development, the corporate adoption, anything that touches AI is doing quite well. But exclude all of that, and you essentially have business investment that's stagnant, which would likely indicate that there is some kind of headwind from monetary policy. So it really depends on which segment of the economy you're looking at in terms of evaluating how restrictive monetary policy is.
Right, but from a policymaker standpoint, at the end of the day, famously they operate with these very blunt tools. Shouldn't they just be looking at, well, how does all this stuff net out for the macro economy? And shouldn't they basically be approaching it from a 30,000-foot perspective, or is there signal in one thing and no signal in the other thing? How do you think about that, Greg?
I think it really depends on the type of shock that we're going through. This is an unusual shock or series of shocks that we're facing. These are all supply side shocks. And monetary policy is best equipped, even with blunt tools, to respond to demand side shocks. But when it's supply side shocks, they have countercyclical effects. They either lift economic output and reduce inflation, or they do the opposite. They constrain economic output and lift inflation, which is very hard to deal with from a central banker's perspective, not just in the US, by the way, across the world. And right now, we're seeing a series of supply shocks: trade and tariffs, immigration, the advent of AI and the technological lift there, fiscal policy. All those shocks are increasingly supply driven. And they make it very difficult for central bankers to react in the appropriate way because they're just not equipped to deal with these conflicting objectives where employment might be slowing and inflation's accelerating at the same time. These are counter-cyclical moves that are very difficult to deal with.
So Allison, what do you think is the optimal way to behave and conduct policy in this environment? Is it basically just, move slow and, keep looking out the window, or what's the best approach here?
I mean, I'm old school with monetary policy. I'm just like, have a narrow mandate, do it well, do what you can do. Don't try to manage aspects of the economy you can't do, because it just undermines monetary policy in all circumstances when they try to overstep. One, it makes it more political. Two, they can't be effective managing supply side shocks, which just undermines their credibility. And credibility is arguably their most powerful tool. So I think, I mean, I said, like, I like a narrow Fed mandate. I like rules-based monetary policy. That might be my vintage, but I think we got into sort of a dangerous place with monetary policy during the financial crisis, when it was the so-called only game in town. And it is true that, like, our politics are broken and we're not doing the best economic policies from Washington anymore, and that probably hasn't been true for a while. So we look to the Fed to solve all of our problems, including serious structural issues that Greg discussed in the economy. And I think it opens, once we start looking to the Fed to sort of solve all of our problems, it becomes inherently more political, which I think is just dangerous. I think an effective Fed, a credible Fed, is so important. Independent Fed is one of the most important tools you can have for a successful economy. And, they are facing all these challenges, but that's because we've put in all these challenges on them. And that probably, isn't for the best.
All right. Well, let's look real quick at how the Fed is thinking about the economy right now. Of course, we're going to get the most up-to-date thing we have is the statement. Greg has already brought our attention to a few items here, but here it is on the screen. So the statement as it stands today now reads: available indicators suggest that economic activity has been expanding at a moderate pace. As Greg, I think, pointed out, previously it said recent indicators suggest that economic activity moderated in the first half of the year. So, slight change in the wording there. Next, they say job gains have slowed this year and the unemployment rate has edged up but remained low through August. More recent indicators are consistent with these developments. Of course, they're being very cautious about the way they word this because there's a lot of information that we just don't have. And then finally, they say inflation has moved up since earlier in the year and remains somewhat elevated. Towards the end of the second paragraph, we have a slight tweak. It now says the committee is attentive to the risks of both sides of its dual mandate and judges that downside risks to the employment rose in recent months. Let's see. Of course, we have the change effectively announcing the end of QT. The committee decided to conclude the reduction of its aggregate securities holdings on December 1. And then finally, down at the bottom, we have this bit where Schmidt preferred no change to the target range for the federal funds at this meeting. And of course, Stephen Myron preferred 50 basis points. So let's talk about the information that we have and the information that we don't have when it comes to the labor market, if we can right now. Actually, let's talk about the confluence of the data, and let's put a little bit of a finer point on it, right? So we just got CPI, Greg and Allison, which suggested that the situation was pretty good, like maybe not quite as bad as some forecasters were expecting in light of tariffs, but it was absolutely not pristine. We've got 3% inflation in the United States of America. And then there's this question of the labor market data. And we have sort of, unlike inflation, we have a wide variety of private sector labor market series of announcements, including layoffs from UPS, Amazon, Intel, Accenture, and yet unemployment claims from the states. Of course, we're not getting this published at a national level, but if you add up the unemployment claims from the states, they suggest that we're still only around, Bloomberg Economics gets a figure of about 227K for the week ended October 18th, which is not terrible. In both cases, you can look at the inflation situation and you can look at the labor market situation and you could say, this is okay. Like, this is so-so. There are clearly risks here, but it's not demonstrably terrible. And so I guess the question is, which part of this data story do you want to anchor to at a time where it's very hard to have a high degree of confidence in any story in particular? Do you think that's right, Greg? What story are you anchoring to?
Yeah, I mean, I think you alluded to the two top questions for Fed policymakers today. One, is the pass-through of tariffs going to be a one-time shock, right? If it is, then the Fed has the latitude to neutralize monetary policy if, in fact, it does believe that labor market momentum is slowing, that labor demand is slowing. When you look at the latest inflation data, I think you have an illustration of what's happening under the hood once you lift beyond just the headline numbers. You're seeing essentially a pass-through of tariffs that is gradual and uneven, likely around 0.6 to 0.7 percentage points, according to our calculations. But you're seeing at the same time disinflationary effects, pretty strong ones, in fact, from the shelter side of the picture. You're seeing housing costs continuing to diminish, whether it's rent or owner equivalent rent, that are pushing inflation lower. So you're getting these conflicting tailwinds and headwinds in terms of inflation. The tariff pass-through is visible in apparel, in grocery prices, in furniture prices, somewhat in car prices, though not fully, and there's more to come. So this is likely to be the picture. We get a one-time price effect from tariffs, and then disinflationary forces still from the shelter side. The key question is what's happened to the services side that are dependent more on spending, like travel in particular. Then you have the question of what's happening on the employment front. And there, the picture is extremely mixed. As Allison was mentioning, when you look at the overall pace of payroll growth adjusted for the massive negative supply shock and the fact that as a result, we haven't seen much of a rise in the unemployment rate, you could conclude that there's no real reason to be easing monetary policy or even neutralizing it. I would tend to lie on the downside risk of that picture. I think that when you look at the hiring rate being at a 12-year low, when you look at the slight uptick in layoffs across a number of sectors over the course of the past few months, when you look at job growth concentration in a few sectors, when you look at wage growth that is gradually continuing to diminish, those point to softening labor market demand ahead of the softening in labor supply, and therefore would justify a neutralization of monetary policy, not an easing, but a neutralization of monetary policy. That would be my take. But as we can see here with the dissents on both sides, there isn't that consensus view of where the economy is headed, where inflation is headed, and very importantly, where the employment mandate is headed.
Yeah. Well, and then there's the question. Neutral is quite a bit higher than I think even the consensus view on the committee. What is your view of neutral, Greg?
I think the neutral pace has moved quite a bit higher and then lower. The negative supply shock that we're seeing right now from tariffs and from immigration restraints is likely pushing the neutral rate back lower, closer to 3%. I would think that the Fed has some room still to get to closer to that neutral rate. Nobody really knows what it is. But to come back to a point that Allison made earlier, I think it's important to look at how the economy is behaving in order to get a real-time assessment of where the neutral monetary rate, the Fed funds rate, is. And if you look at the economy, it doesn't seem like we're in an extremely restrictive monetary policy stance. It's modestly restrictive with some downward pressure on the economy coming from monetary policy, but not an outsized effect and not a homogeneous effect on all segments of the economy. As I was talking about this bifurcated outlook, I think you're seeing that revealed across the different sectors of the economy. So I would tend to think that somewhere between 3 and 3.5 is where the neutral is right now. But as with any type of guesswork, we have to be very cautious with any type of precise estimate of where neutral is.
All right, so this is a very challenging environment here. We're a little bit, we have a view, but we're not highly confident in that view when it comes to the labor market. I think you can sort of say the same thing about inflation, and we're not 100% sure where neutral is. So a lot of open questions here. Who is the best person for the job to navigate this environment? Famously, people have different views about how Chair Powell has done. I actually think he's done quite an extraordinary job navigating this environment so far. But President Donald Trump does not agree with me, not even a little bit. And he is convinced that he must replace him, and so he will next year. Treasury Secretary Scott Bessent has put out a short list of potential folks to replace him, including some Fed insiders. Governor Christopher Waller and Governor Michelle Bowman, Vice Chair of Supervision, are both on the list. We know that White House National Economic Council Director Kevin Hassett is on the list. There's an interesting private sector name, Rick Reeder from BlackRock. Also on the list. So
Well, I think we may have lost John here for time, but
do you want to jump in with your pick?
Yeah, well, I don't know if it's my pick, but I've been fairly aligned with Governor Waller's perspective in terms of his evaluation of the labor market and inflation dynamics. So just in terms of alignment with the views, I would tend to think that Waller, having the current governor role and having been the leader in terms of the direction of policy over the past few months, would be a good pick in terms of the next Fed chair. But do you think differently?
I think he'd be a fine pick. I honestly think they're all fine. There's no one I'm just like, no way. It's like I'm kind of liking Rick Reeder, mainly because the Fed has just announced that they're now in the business of managing a $6 trillion fixed income fund. So maybe we don't really have anyone on the Fed who has serious finance experience. They're not even financial economists. They tend to be more macroeconomists. So, I mean, as I said, if the main job is now being a major fixed income manager, maybe we should have someone who knows how to do that.
Yeah. The last thing we want is the Fed to be saying that the balance sheet management is on autopilot. We know how well that worked back in 2019. So yeah, that might be an external candidate, a dark horse in terms of the race.
Well, I'm back. I hope you can see and hear me.
Yeah.
All right, very good. I heard everything you were saying. I was just snooping in the background. Okay, so to wrap up, I want to let everybody go here before Chair Powell's press conference. But I want to ask you both real quick, lightning round. What do you still want to hear from the chair himself that would clarify where we're going here, Greg?
I want to hear a sense of the direction of travel next year, because I'd like to see much more clearly where Fed Chair Powell stands in terms of his preference of monetary policy in this environment. We know he's an agnostic Fed chair. Going into every meeting, he tends to listen to everybody's views. But I'd love to hear what the sentiment was in the room when this vote took place, because one dissent is one thing, two dissents on different sides reflects likely a much more polarized FOMC meeting than has been customary over the course of the past few years.
All right, Allison, same
I
question
want
to you.
to. I want to know where neutral is. I mean, as Greg just pointed out, it could be 3.5%, which means only one more cut. Otherwise, they're in full-on expansionary mode. They could justify we're going to neutral. We're going to expansionary. That's a big jump when you have a 3% inflation rate. So I think we'll have the best sense if we knew where he thinks neutral is.
All right. Yeah, that's what we all want to know. But good luck getting an explicit answer there. All right. Well, thank you to everybody for tuning in. Thank you for bearing with us through a couple of technical hiccups. Thank you to Greg Dacko, Chief Economist at EY Parthenon, and now the President of the National Association for Business Economics. Thank you, Allison Schrager, Senior Fellow at the Manhattan Institute. And we will see you guys again soon, I guess sooner if we get some data again at any point in the near future. See ya.